Nice to meet you.
Bonjour, on vous dit règlement en français ou en anglais?
C'est en anglais.
Sorry for my English. So each team has 20 minutes to present its case to the judges. I will open up a sign of the last 10, 5, and 2 minutes as well as for the last 30 seconds. During the last 10 seconds, I will indicate with my finger the number of the second remaining. If you have not finished your presentation after 20 minutes, you will be stopped in order to proceed with the Q&A period. Please note that at any time you can say or reference the name of the location of your university. I will now let the judges introduce themselves. You can start the presentation when they are finished.
Hello, my name is François Trout. I'm working at Desjardins Financial Security Head Office, supporting SFL Network.
Hello, my name is Martin Poirier. I'm part of management of SFL Financial Center.
Mario Lavallée, Professor of Finance, Sherbrooke University.
Mr. Latendresse. So you've had quite a successful career. You've been in the insurance and brokerage business for quite a while. Recently, you've just acquired from Mr. Richard in the past few years the business of SFL, which is in partnership with Desjardins. So you've had quite a few stellar years in the past. You've recently received awards for the years in your sales growth of 2012 and 2013. But unfortunately, your sales are stagnated in this year, in 2014. So, in order to rectify that, you've had a loss in the productivity PC measures of your recruits. Your new recruits have been dwindling from a record of 18 to 9 currently. So there might be an issue here in order to get sales to come back up to the state where you would like them to be. So in order to do that, there's two options that you have. Either pursue the internal growth strategy and increase the amount of your new recruits and get your sales back up to the figures where you would like, or look at the acquisition of Clefdal, which is another firm owned by one of your friends, as you know, across the city. So, and Clefdal currently is 75% owned, as I'm sure you're aware, by Mr. Leveresh, and the other 25% is owned by the retired owner, which we'll discuss going forward. So, today, in terms of our mandate, we need to provide a recommendation on these two projects. And in order to do so, the reason being is to increase those stagnating sales, to increase your new recruits, and also to increase your market share across the city. So, in summary, what we have came up with is our conclusion is that you should proceed with the acquisition of Clefdal, as the value of the firm with synergies is 4.51 million, and is therefore accredited to your firm to acquire this target company for at the value that was last stated at 1.8 million.
Okay. Monsieur François, Martin, Monsieur Mario. Today we're going to look at a lovely agenda, and through that agenda we're going to look at different points we actually covered through the case we're actually looking at. And we're going to start with a little analysis that we did. It's going to be a little industry and a company analysis, looking at a couple of points that are going to lead us to the financials that we did. And our analysis is going to link to why we have concluded to that conclusion, that recommendation. So we didn't just come up with these numbers out of nowhere. We actually chose these numbers based on the analysis that we have done. Also, we're going to look at our financials. Our financials, we're going to do we did our status quo, and we did our firm strategy, and after that, we did a total valuation, and we have our final recommendation. We're going to come back to our final recommendation through a little synergy we actually did. So starting off with our analysis, we're going to start off with a little industry analysis for everybody that is in this room. And we're going to tell you about that industry that we are covering and that we looked at today in the case. So the industry analysis that we looked at is mainly an insurance industry, so financial insurance industry. And in the financial insurance industry, we cover mainly 3 different points, or it's like split into 3 different segments. The first segment, for example, if you go to a bank, you would see a bank employee covering an insurance, that could be one part. Another part could be the financial security advisor. Another thing you could look at is a non-exclusive insurance network. So that person could be a self-employee. For example, he could do the insurance to pretty much a self-employee, so a customer could come to himself and he could do it to himself as long as he is licensed. So to all of these, you actually have to have a license to be able to do it. And what we are going to be covering today, what we looked at, is mainly the last one, which is the non-exclusive part. So it's most likely like a brokerage part. So we're going to continue on. So little company analysis. So what we looked at and what we are mainly going to cover today is why this model, or the SFL, we found was very important, is because of what the big strong point of it was, the business model. So we found that business model was very, very important, was very good, and it was a very key point that could actually be a very strong opportunity to it later on. So the main 3 points that we looked at was customer relationship management, ready-to-use technological services, and continuing education. So these are the 3 things we looked at. And some stuff we actually looked at are also weak points that were not on the slide, but we also looked at the weak points. What was the weakest points, and why we actually thought we should actually look at the external rather than the internal part of actually that project. Why did we choose the external part? We chose the external part because we thought these 2 companies could pretty much merge. It's like that they have that nice synergy together. So we thought the external part was pretty much a better idea because they do have weak points as they have strong points. And what the weak point we looked at was their recruitment. So that was, we found a weak point. So as they did have that strength, they did have a weakness. So we thought the external project would be a nice, pretty much benefit. So we're pretty much gonna move on. So we're gonna look at some of our financials, and I will bring it up.
Okay, so we're going to move on to the financials. And in addition to my colleagues' comments on the industry and the company, another thing to reiterate is the fact that the company SFL has great value-added services. There's great services in terms of training employees, new recruits, developing business for employees who have been there for over 36 months, and also in addition, there's been several new hires at the firm, which will be able to enable the current representatives to increase sales, but also when we acquire Cleft Door, that'll also be able to create some added value in training them as well. In addition, as you know, the industry in Quebec for insurance and brokerage is very robust. It's roughly around, with the mutual funds and savings, it's around $482 billion. In Quebec alone. It has been resisted the financial distress caused in 2008 and has remained relatively stable as a portion of GDP. In terms of your company, a lot of the strengths that you have a lot of experience. You have multiple suppliers for your brokerage. You're not an exclusive supplier for you don't have a sole supplier agreement. So that means you have many more products to offer your clients, which enables them to have more diversified insurance products and savings. So we believe that this is a great asset of the company. And we believe that the value-added services that Desjardins provides SFL in the partnership is key to going forward with this acquisition. So, in terms of our assumptions, so basically what we did is we assumed the status quo of Cleft Door as is. Cleft Door's sales have been quite stagnant as well in the recent years. So what we wanted to do is assess Cleft Door as is, and then assess it in adding the synergies that we think would be able to materialize through adding it into the organization of our SFL branch. So basically, the sales for Cleft Door is roughly around 1% historically. So we kept that in line, and due to the compliance and regulatory requirements that are imposing hardships on smaller brokerage firms, we believe that their sales will actually start to decrease with increased competition from larger brokerage firms and insurance firms that have much more products for their suppliers. In terms of So yeah, these are in line with the historical growth rate and decreasing, as I said, increased competition. So moving forward with our synergy assumptions. So we believe that when we acquire Cleft Door, in the first year is going to be quite hard for the synergies to materialize because there's going to be integrations of human resources, to bring the new recruits. Again, because there's a 6-year lease on the building in the other part of the city, we won't integrate that and get a bigger branch. So we will keep that as is. We'll keep it there because we'll also have a higher market share because it'll be in a different area of the city. So based on our synergy assumptions, we believe that because we will have an extra representatives that will be acquired through Cleft Door, through our value-added services, through our professionals that work in Desjardins as well and that provide their services to the SFL, that we would be able to tap into a greater market and significantly increase our sales. So we believe that in year 2, the sales will increase about 5% to 10% and then 15%, which is our time frame for the synergies to materialize. After then, we figure that it'll be around 3% going forward, which is in line with long-term GDP growth rate. In terms of cost synergies, basically we thought eventually there might be some overlap of our employees, so we figured that there would be a 2% reduction in salaries and benefits. In terms of, because that we are keeping the other location for the remainder of the lease, there won't be significant cost synergies in terms of rent, although a portion of it is paid by the representatives. So we figured that there would be synergies in advertising and promotion by roughly 1% as well.
Thank you. Now, drawing on all of the assumptions and the analysis that both of my colleagues outlined in the slides that we just discussed, let's now go towards our discounted cash flow analysis, which is what we use for both the base case value as well as the synergy value, which we then combine to create a total value of this firm to you. As you all know, one of the key assumptions is the discount rate, as this is your essentially required return given the capital structure that you expect this deal to be using. Therefore, beginning with the assumptions within the weighted average cost of capital, first we assume that the return on the market was 5.45%, and that is simply the geometric average return of the S&P 500 between 1928 and 2013. Clearly, this is the opportunity cost. Many of your clients, presumably at least in the savings segment, could be in mutual funds, and therefore we use this return on market as our base case. In terms of risk-free rate, we use 2.4%, which reflects approximately this year the average rate of the 10-year Canadian bond. Why this specific bond? Because we feel that you are going into this new venture as a long-term horizon, as a long-term investment, and therefore we felt that a similar long-term bond, therefore risk-free asset, was therefore most appropriate in this circumstance in terms of calculating our overall discount rate. In terms of other risk premiums, clearly, as we well know from Farm and French, there are certainly other risk premiums that are added on to the base market return, given the specificities of the deal. In this case, we felt that a business risk premium of 300 basis points, or 3%, was most appropriate, given that Cleft Door is in an industry with waning sales. This is a result of many factors, notably, as my colleague mentioned, that there are certain regulatory requirements that are becoming more burdensome to them. Furthermore, they may lose more agreements with different suppliers. As we well know, they've already lost one of their major ones, and that's simply because of consolidation within the industry, and it's much more difficult for these independents to gain these deals with these suppliers. In terms of liquidity risk premium, clearly you're buying a private firm, therefore we felt that a liquidity risk premium, if for whatever reason you choose to, in terms of sell the asset, and this liquidity risk premium reflects the costs of doing such, the timeliness of potential sale of this asset in the future, as well obviously the price attainable. Finally, in terms of tax rate, we chose the effective tax rate of Cleft Door, which is approximately 19%. Moving on to our other assumptions. In terms of our change in non-cash net working capital, we felt that a net working capital ratio of 1 was most appropriate for the Cleft Door. And we also assumed a net 30 on the operating expenses, therefore 1-to-1. Clearly, if you subtract current assets from current liabilities, you achieve 0. Therefore, that is the zeroed out figure that you see on this slide. In terms of CapEx, clearly we know it's very common within the industry to be leasing your assets, as Clefdar is currently. Therefore, CapEx was estimated at a very conservative number at 1% of revenues, given that although the lease does expire, certainly you will potentially either remain in the location. As you know, it's a very good location, it's optimal. Many of your customer service representatives that are there certainly live nearby, and therefore you want to keep them, as they are the talent of Clefdar and that you need so dearly for your own business. And therefore we assume CapEx will remain low, in line with the general view that staying in the same location and leasing was most likely the option that would be taken. In terms of depreciation of assets, as you are leasing assets, your tangible assets are essentially equipment or very minimal in terms of, at least in comparison to large fixed assets. Therefore, we kept it in line, as we're assuming these assets are things like office equipment, and therefore would stay in line even forecasting forward. Finally, in terms of the beta, we know on average that banks approximately have a beta of 1. They follow the market. However, this is a financial services market, and you are essentially selling a potential investment in the market, and therefore clearly we feel that this would be more attractive when the market is doing well and it's very attractive. And for that reason, we felt that a beta 1.2, so slightly more sensitive than the overall 1 rate of the general market, was most appropriate, given that you are pitching certain assets that are very, very sensitive, at least in terms of their demand, to what generally the market's doing, at least from the perspective of mutual funds. Now, what does this all mean put together? We use the capital structure that was proposed in this deal. So 70% would be funding from SFL, as well as 30% additional equity, certainly potentially from a private investor or something to that effect. Overall, that cost of equity results to approximately 15%, that is using CAPM as our basis for coming to that number. In terms of cost of debt, we do have information, some clarity in that regard, and we know that you do have access to funding at 5.8% through SFL, and that's certainly something that you would use in such a circumstance where you would choose to go ahead with the acquisition of the target firm. Finally, once again, just reiterating that overall the tax rate that was used was the effective rate at 19%. Now, what does this overall mean? It means the weighted average cost of capital, or in this case, the discount rate, which we are using for both the status quo valuation as well as the synergy, is 7.77%. So clearly between the two, given the capital structure, and this is your required return. So therefore, if for whatever reason, or in this case, if you are able to acquire the target at less than this, then we know for sure you are meeting at least the hurdle rate of 7.77%, which was estimated to be assumed as the required return of this investment. Now, moving on to the actual valuation, clearly we can see that the assumptions are put in place here in the discounted cash flow analysis of both the status quo as well as the firm with synergies. In terms of more specifics, clearly the EBIT is fairly flat, and that reflects overall the assumption that growth would be fairly low, would remain fairly stagnant with the firm without the synergies of obviously of your firm, given all the support in marketing and overall efficiencies that can be reached if the two firms would merge. Now, the value of the synergy. This is clearly the gem in terms of the reason that you should pursue this investment. We can clearly see that given the fact that they have the things that you lack, and certainly you have things that could muchly improve their operations. These, as my colleagues mentioned, were the fact that they have a young, vibrant set of employees, which is exactly what you're looking for. It's a proven track record, as you know, each employee, what their revenue creation generates and to the top line, and therefore this is certainly something that can complement your own employees. Furthermore, we also know that you, however, have the support of Desjardins, and therefore you have the ability to market, to penetrate new markets, and overall expand your market share through the use of your services complemented to their resources of human capital and employees. Furthermore, overall, this will achieve your goal of growing your business, of increasing your revenue growth, and kickstarting a new set of employees with broader and higher goals in terms of revenue generation. So overall, this concludes our recommendation that you move forward with the opportunity that has presented itself at acquiring the firm Clef d'Or at 1.8 million, as this is far less than the true value of the synergies and the intrinsic value of the firm at 4.51 million. We'd like to welcome any questions.
As the other possibility that which was internal growth project, have you done any calculation on the payback of that opportunity?
No, we have not, as we felt that given the large discount that Clef d'Or was, and this was our preliminary analysis, and as we noticed, there's a very large discount in terms of what we foresee to be the benefits of this acquisition. We felt that a qualitative review of the overall condition of your firm, given the fact that your recruiting is certainly an issue in comparison to the clear benefit and the clear fact that recruiting in Clef d'Or is essentially a strong point, that they have a young and vibrant group of workers. There was a very good synergy that would favor this deal over potential revenue generation to a more internal strategy.
I bought SFL Hochelaga 5 years ago for 4 million. And you think that Clef d'Or worth as much?
Clearly, supplementary analysis needs to be done, but at least from a preliminary analysis, certainly we felt that the value of Clef d'Or was in excess of at least what the purchase price was, given the very conservative assumptions of only 1% year-over-year growth, as we mentioned.
One part of your valuation is based on the weighted average cost of capital of the financing of the transaction. What would happen if instead of 70%, SFL would finance us at 95%, 98%, or 100%? How much more would we pay Clef d'Or because of that?
Well, obviously your WACC would come down, because your cost structure would be more oriented towards a lesser cost of debt, so lesser KD, and certainly as the value, your discount factor is decreasing, the present value increases. So clearly that will be, in this situation, you would, at least the overall value of the firm would be increased. However, given the fact that your discount rate would be decreasing, we feel that would be the effect.
But would that justify
Pay more?
to pay more?
No, we wouldn't suggest to pay more because, as we stated, the last price quote from Mr. Bresch was 1.8 million, right? And that was for 75% stake in the company. So the other 25% is owned by his other partner, who is now retired, and his son, as it was stated, is the retired partner thinks that his son is going to take it over, but unfortunately, I guess he doesn't have the assets to get financing for that. So we don't say that we would pay more than 1.8 million. We just know that the intrinsic value to us with the synergies to SFL would be much greater than 1.8 million, and therefore we could capitalize on that by setting a ceiling price around 1.2 million.
Talking about this 25% owned by Mr. Lapanache, how do you implement the synergy that you talked about without 100% of the company?
Yes, well, that's why in the first year we only basically we didn't see any synergies being realized, right? So our reasoning behind it was because his son does not have the assets or the assets to basically get the funding required to buy out his father's 25%, or a higher percentage if possible. Because that's not a possibility, and because he's working as a representative and he bought his father's client list, who has basically funded his own son, we don't believe that he would have sufficient means of capital. And with these pressures, the regulatory pressures that are forcing the small brokerage firms, we believe that perhaps, you know, that fact and that risk might perceive Mr. Labrache to sell his 25% stake at, of course, depending on negotiations, it could be a certain percentage of premium, but that's what our rationale was.
Motion, do we-
Yes, nice.